Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And before we get into this week's episode, I'd just like to remind you that I've written an ebook that contains all the information that I think you need to take into account before you make any changes to your mortgage. So if you're coming up to an end of interest-only period, a fixed rate, or you're looking at borrowing this year, certainly have a look at that ebook. Almost 500 people have downloaded it, so it's obviously resonating to some extent, and you can do that just by going to prosolution.com.au/ebook. Just click on the button. You don't have to put in your email or any of those sorts of details, and I hope you get some value out of it. Okay, so let's get into this week's podcast then, which is really having a look at how index funds did over the course of 2020, and then also, I guess, drawing the lens a bit wider and looking at sort of longer term performance also. Now, of course, share markets have been really volatile over the last couple of years, more volatile than usual, I should say. You know, markets fell around about 30% in March 2020 when COVID hit, of course, but then recovered quickly off the back of a lot of government stimulus and zero interest rates, something a price we're paying for today. And really, until the end of 2021, the market was very, 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 very strong. And then really 2022, markets fell again by about another 20% and have been very volatile since. And those falls were mainly precipitated by obviously central banks hiking interest rates. So it's been a wild ride, and arguably these large volatility events that are caused by a couple of external factors, often they create mispricing, overreaction, more volatility. And if you're an active fund manager in the share market, arguably that creates much greater opportunity for you to outperform the market. So what I wanted to do is say, well, given what's happened in share markets over the last couple of years, surely active fund managers should have performed better. And what I wanted to do is go and have a look at whether that's actually been the case in this episode. Okay, so let's talk about active fund managers first. I think it's really important to clarify what is an active fund manager, what are they trying to do, and then what is an index fund. So an active fund manager really is trying to pick stocks. They're trying to invest in a basket of stocks and pick those right stocks in order to achieve better returns than the market. They can typically use two sort of primary overarching methodologies to do that. So a value approach means that they're going to try and pick stocks that they think the market is they're undervalued on the market, and they'll go and hold those stocks on the hope that eventually the market agrees with their estimate of value. And sometimes it can be obvious that if a really good company is trading on a 10 times PE and it should be closer to 17. Sometimes it is a bit of a no-brainer in that regard. So that's a value approach. Alternatively, they can focus on companies that they think are going to be very high growth. And so there's less sort of concern or focus on what they're currently valued at. It's more about what they could be valued at in the future, particularly if they've got a growth product or brand or in a growth market, those sorts of things. Now, the reality is there's lots of different approaches that active fund managers use in order to try and beat the market, and value and growth are really just two, I guess, really large categories, but sometimes the strategies can be, a combination of those two things. Because active fund managers have to employ a team of portfolio managers and analysts, they charge higher ongoing fees. So typically an average active manager will charge about 1% per annum as an investment fee to sort of cover those costs. Okay, now let's talk about index funds then, because index funds are an alternative to active management. So traditionally an index fund will invest in a basket of the most valuable companies listed on a particular exchange, stock exchange that is. So for example, there's an ETF and the code is A200, It's a ETF run by Beta Shares, and it's the lowest cost Australian market ETF fund available, and it charges only 0.04% per annum in fees. So if you invest $100,000, you're paying $40 a year in fees. It's very, very cheap. And essentially it invests in the ASX 200 index, which is really the most valuable 200 companies that are listed on the Australian Stock Exchange. And that's what an index fund does. It invests in that proportion. So the total value of the 200 companies listed on the Australian Stock Exchange is around about $2.1 trillion. BHP's value, or market cap is often it's called, is $240 billion. So really BHP represents around about 11% of the total index. And that means that if you invest in A200, this ASX 200 fund, 11% of your money will be invested in BHP, nearly 8% in CBA, 6.5% in CSL, and so on and so forth. So that's how a traditional index fund works. And that's what most people will be familiar with. But really, by definition, an index fund is simply a managed fund that invests in a very broad basket of companies. And they typically use a rules-based approach for determining, which stocks are included in that basket and in what proportions are we investing in those stocks. So the A200 example that I just gave you is based on market cap. So it depends on, is BHP trading at $50 or $30? And that'll determine, in terms of its share price, and that'll determine how much we put into CBA. But the point is that we've got a very large basket of shares, and we're using a rules-based methodology for determining which shares we're investing in and how much we're going to invest in each share. Now, because we're using that rules-based methodology, we don't need a portfolio management team. We don't need analysts and so forth. We really probably just need a spreadsheet to run that rule, and that's why index funds are typically much lower cost than active management. Okay, so now we've set the scene. Let's have a think about, or have a look at, more importantly, what happened last year. And as I said at the beginning of this episode, there's been a lot of volatility events, and when the RBA and other central banks started hiking interest rates, maybe it should have been obvious to some active fund managers, for example, that growth stocks are going to be hurt by that because they don't like higher interest rate environments, because they typically need to borrow and fund growth. And so maybe that it creates better opportunities for active managers to outperform the market. And so I thought it'd be interesting to see what happened. And of course, there's a table there's a link in the show notes and the blog on the website, of course. So there's a few numbers here, but essentially in the US market, about 49% of active fund managers outperformed the index. And in Australia over the last year, so this is calendar 2022, about 42.5% outperformed the index. So less than 50 in both situations in a year that you would argue, created plenty of volatility and therefore plenty of opportunities. And if we look at the last 3 years, which is going to include 20, 21 and 22, really let's call them the COVID years, and we've had a large correction in 20, a bull market in 21, and then another sort of bear market in 22. Only 25%, so a quarter in the US, outperformed. In Australia, about 1/3 outperformed the index, which is pretty poor performance considering, as I said, arguably it should have been a little bit easier to do so over recent years. Now, when you have a look at longer term data, because it's interesting, and it is only interesting, there's no meaningful data really, interesting to look at that shorter term return. What's more compelling is longer term returns. And so if we have a look over a 15-year period, so the last 15 years ending December 2022, only 7% of active fund managers in the US beat the market, and 16% here in Australia. Now, Australian active fund managers probably do better, not because they're smarter, but because Australia's a much smaller market, and therefore it's got fewer participants in it, and therefore arguably it's less efficient. And it is dominated by really the banks, a couple of supermarkets, the miners and so forth. So there's, that really throws a blanket over most of the market. So that's why you've got a little bit of a difference there. But whether you're, 16% outperformance isn't a great record for active fund managers. But the point is, and the really important point is it's not the same 16% over that 15-year period, or in the US, the same 7% over that 15-year period. So, for example, in June 2018, there were 79 Australian active managers in the top quartile of performance. So, in the top quarter, in terms of investment performance, up until June 18, there were 79. 4 years later, none of those 79 managers were still or remained in the top quartile of performance. And what the stats show us, and they're very consistent, there's a very deep amount of statistical research here, is that just over 40% of active fund managers can remain in the top quartile for 2 years running, and only about 15% 3 years running. And based on this example, none in the fourth year running, although I have seen some studies where it might be 1 or 2%. So essentially, for active fund management to work, what you need to do is you've got to pick which active fund managers will outperform over the next 12 months. And then you've got to replace those managers every 1 to 2 years with new managers that are going to outperform. And you must do that with consistent accuracy to ensure that, because you're paying higher fees, you're paying 1% per annum, you need to do that consistently well to ensure that you're going to beat the market. And of course, I don't think you need to have too much, financial knowledge to work out that the probability of doing that is really slim. Now, the example that I gave you of indexing was the A200 fund, which is the fund that invests in the ASX 200, and that uses traditional market cap indexing. And I should say that traditional market cap indexing has performed well. Look at the studies that I just shared with you; it's performed well and much better than active fund managers over long term. But there are some weaknesses and criticisms with traditional market cap indexing that I think investors should take into account. So, for example, traditional market cap indexing uses the market value, the relative market value of each participant within that index, as a way for allocating how much of our money we should be putting into that company. So remember, I said in the example 11% goes into BHP. The problem is, though, that the share price isn't always an accurate predictor of value or the value behind the company, and it doesn't always make sense to follow that price movement. So, for example, since the start of February this year, CBA's share price has fallen around 10%, and Telstra has risen around about 3.4%. They're both in the top 10 stocks in the index. So therefore, if an index fund was to rebalance now, it would have to sell down CBA, it'd have to reduce its exposure and buy more Telstra. But selling CBA now, just because its share price has dropped, doesn't make a whole lot of sense. Of course, there's been a lot of negative sentiment with respect to global banks, but it is what it is. I mean, it's just sentiment, and that sentiment, in fact, is slowly disappearing. So the main criticism then of traditional market cap indexing is that allocating your investment in particular companies just based on its share price and rebalancing those, and most index funds will rebalance twice a year. Rebalancing based on those current prices also creates inefficiencies. And there's other index methodologies of which I've discussed in this podcast previously, such as fundamental indexing, which looks at the fundamental value using factors other than price. Factor-based indexing, which is really, a quality or value overlay applied over an index or in a particular geographical market. Equal weight index can be really worthwhile if you want to skew away from large cap, which is what we do in the US market, or have been doing in the US market. And I believe that really a combination of different indexing styles in a portfolio mitigates or balance out some of the pros and cons of these different index strategies. Now, to say indexing is popular with investors is probably an understatement. It's very popular in the US, even for institutional investors, not only just retail investors, so like you and me. And it's estimated that about $16 trillion is invested in index funds, which is up from only $3 trillion 10 years ago. So a significant amount of money has moved into indexing. And a client asked me a really good question last week. He said, if index funds continue to rise in popularity, will returns suffer? Because everyone's investing in index funds, essentially they become the whole market. And it is a really good question. So one of the most important parts of the share market is the price discovery process. That is that you have companies that have to by law release information to the market. You then have thousands of market participants that crawl over that information, do their own research and so forth, and they reflect their views based on their trades. And it's a very transparent market. You can see what people are bidding at and what people, in terms of to either buy or sell. And if shares are traded, a lot of shares are traded each day, it gives you a relatively efficient idea of what a particular stock's price is, or at least what the market thinks it's worth. And that's called the efficient market hypothesis. And that's the important part. It is estimated that the trading by index fund represents only 5 to 7% of the total trading volume in the market. So whilst index funds are certainly owning the market, they're not really influencing the price. Or if they are, they're influencing the price to a lot less extent. And the reason for that is that index funds don't need to trade. They rebalance every 6 months, but they don't need to trade in the market and trade stocks. So it really doesn't matter then how big indexing gets, as long as index funds don't start trading a lot and start influencing the market. That's when they won't work. But it was a great question. I thought I'd just address the answer in this podcast episode while I was here talking about the topic. Okay, to sum up, 2020 was yet another year that showed that active fund management just really isn't worth the higher fees that they charge. And that if we're going to follow an evidence-based approach and we're going to look at that long-term data, which is very, very compelling, then it just shows us that particularly with developed stock markets, indexing really is the best way to go. And using a variety of index strategies makes a lot of sense as well. Now, there are some sub-asset classes where active management makes sense, such as emerging markets, for example. But in the main, if we're investing in developed markets, we're really using an evidence-based strategy, which is, the foundation of which is indexing. And when you look at the portfolios that we put together, the weighted average cost, in terms of investment cost, is around about 0.3%, which is very low. And even some of those portfolios still include a little bit of active management where it's appropriate. Okay, that's it for this week. Just a reminder that ebook around that mortgage ebook, the link is in the show notes if you haven't got a copy of that yet. Otherwise, until next week, bye for now.